Good mid-morning, everyone. Hope you're all doing well. Hope you all had a wonderful, long, safe, happy, and healthy 3-day weekend, or longer if you took longer to enjoy the Independence Day holidays. And hopefully, maybe saw some fireworks and were safe when you did that too, because of course the news was terrible. There were a lot of accidents all over the place, and there always seems to be every 4th of July holiday. But hopefully you weren't, or any of your friends or loved ones weren't part of any of those mishaps. But market's seeing a bit of a mishap this morning on the heels of some tremendous running up higher. Last week was just a great short week. Markets just drove themselves higher, including into Thursday's close, which is always a positive, especially on a long weekend. In fact, Friday's numbers were pretty impressive, though volume was relatively thin. The numbers were still impressive because, again, that's going into a 3-day weekend. And then we had the follow-up, obviously, yesterday, some pretty nice gains on the heels of what happened on Thursday of last week and all last week. But last week was an up week. The week before was a down week. The week before that was an up week. The week before that was a down week. So we've seen a lot of trading off between investors in terms of sentiment, risk on, risk off. I call it now COVID on, COVID off. Stimulus on, stimulus off. These are the battles that are raging. Right now, it appears that COVID on is going to force stimulus on. And the markets like that. They don't like the COVID on, but they certainly like the prospect of more stimulus occurring throughout the economy. And we know that the additional $600 a week that a lot of folks, not enough, were getting on their unemployment benefits ends at the end of this month. So a lot of folks are going to be hurting. A lot of folks already are hurting. And we talked briefly on Thursday about some of the dynamics in terms of the unemployment numbers. The Bureau of Labor Statistics numbers on Thursday were just really hard to figure out. We saw the unemployment rate drop to 11.1% from above 13% the previous month. At the same time, we saw 4.8 million jobs come back online. I won't call them created, but come back online for the month of June. And we had, I think, 2.5 in May. So out of approximately 22 million folks that began to claim, look for unemployment benefits, 22 million looks to be about the total. And that number seems to be a moving target because there are anomalies within the gathering prospects between the states. So that's the best we have right now, is an estimation of 22 million people had filed for unemployment benefits. The 7.3 approximately million jobs that came back online over the past 2 months belies the fact that continuing unemployment claims remain close to 20 million. They actually hiked a little bit. They're south of 20 million, but they are 19 million. I have the numbers, 279,000, I believe it was. But they have barely budged from the continuing levels of just a shade above 20 million. So that doesn't comport. We talked a bit about that on Thursday, and I don't understand. Nobody understands. And it's, to me, just a bit frightening, if not unnerving, that we don't know really where we are in terms of folks coming back online, in terms of people remaining on unemployment, and again, what the stimulus has done, what it's going to do in the future when we get round number 2, really was what it will be. Markets are trying to figure that out too. Today, the markets are down because European markets started the fall. China is still strong. China has seen some tremendous momentum and just a tremendous burst of interest in their markets and have rocketed higher last couple of days. That continued to today. However, some of the other Asian indices tried to follow suit but couldn't. And then the European markets, when they opened, got hit, and they're closing now and pretty much got closed to the downside, almost all of them. So what happened there? What happened there is economists coming out and governments coming out, the IMF coming out, World Bank coming out, and projecting lower growth than had previously been projected. So obviously we're seeing constant, I would say, reassessment based on what we hope are real-time analytics, real-time metrics. So we know some of them are delayed. There are lag factors in a lot of them, but what appears to be real time seems to be telling a lot of analysts and a lot of governments that yes, we've had a great market bounce, but the economy, global economy, and each of the respective states who have been reporting are now thinking that maybe the bounce that they've seen initially may not last. And at least if it does, it's going to flatten out somewhat. So that's what's hitting European markets today. And that's a reflection of also what we're seeing here. Additionally, what's really worrying European markets today is regulators talking about the banks, European banks, I'm talking about EU banks, not being able to increase payouts on dividends, and perhaps maybe not even paying dividends for a longer than projected period, and certainly not buying back their shares. Now, this is talk. There haven't been any regulatory moves, but the talks today out of European Central Bank and out of the EU are frightened investors, because if regulators are looking at banks as needing to shore up their capital, obviously that doesn't bode well for the banks, which is a reflection of what they have to probably provision for in terms of loan losses. So we're starting to see that return. And it's not as if we've completely cleared that hurdle. We know that hurdle is out there, but right now it seems to be coming back around and impacting the markets. NASDAQ composite, needless to say, bucking the trend. The honey badger, as I call it, the honey badger don't care. It's just going to gobble up whatever capital's out there and go fatter and fatter, and move higher and higher, just defying gravity, constantly making new highs and constantly reaching higher for good reason, because the companies in the NASDAQ composite, in the NASDAQ 100, there are the companies that are growing. They are the companies that are benefiting from lockdown, benefiting from economic growth, benefiting no matter what happens. And that's where the money is going. The capital that is looking for growth is looking for growth in earnings and looking for growth in terms of not only top line revenue, bottom line profitability, but more importantly right now, cash generation. So those companies can withstand whatever comes their way over the next couple of quarters. And of course, we know who those companies are. They're the big mega cap tech stocks in the US, and plenty of European companies also in the tech sectors there. So it makes sense that we see the NASDAQ composite continuing to climb higher, and that the only hope, not the only hope, but a large hope, is that money flowing into the stocks that are doing well will eventually look for undervalued stocks. Some of that may come out of that. Additional capital may come from the sidelines. Investors, especially retail, may pony up more money and go into, again, the beaten down cyclicals. We may see what we saw previously. It's like, this is a rotation, which is a healthy thing, which turned out to be more like speculation than a true rotation. And what we would like to see is a true rotation trade where money starts getting applied, capital gets applied into cyclicals, into some of the beaten down sectors, energy, financials in particular, which would prove that investors see potential for economic growth. We're not seeing that. So we're going to take a look at the banks graphically. We're going to take a look at some energy companies. We're going to take a look at any companies that you guys would like me to look at so we can look at them collectively. And I think that's the direction we want to go today. So right now, what's on the table again is financials are front and center. They're front and center in Europe, and the financials being hit in Europe are they are the culprits that brought down the European indices. So we're seeing that now in the US, and we're going to look at the major banks here. We're going to see that once again, they are under pressure. This is what's helping to pull the market down off of its momentum ride higher. Why? Again, uncertainty. We also had President Bolsonaro of Brazil test positive for coronavirus. Now, a lot of folks might think, well, that really, what do you expect? He's going around without a mask in large gatherings with his entourage, reaching out to people. And it was almost inevitable that he may come down with it. So he had fought it for some time, had tested negative consistently, but this morning we find out that he's tested positive. Now, whether that will shake other leaders in the US into wearing masks socially, as opposed to once in a while for the cameras, but generally more often than not, remains to be seen. It may be the trend. President Bolsonaro and President Trump are friendly, and they have approached the coronavirus crisis with somewhat similar tactics in terms of shrugging off the effectiveness up until recently for the president of masks, or couching it in more libertarian terms that it's a decision that you have the liberty to make or not make. I personally don't see it that way. I think it's for the greater good of the folks around us, the people we love, and the country and the future that we wear masks. I always wear a mask when I'm out. There's no harm in it for me. Is it an inconvenience? Not really. Slightly at times, but social distancing and wearing a mask makes sense. I think we may see more of that now. We're starting to see folks in Congress be more, folks who weren't actually pushing masks, weren't pushing some of the proper procedures we're supposed to be adhering to, becoming a little more vocal about what we all should be doing. And I think hopefully they will start leading by example. We can only hope. So back to a quick glance at the markets. VIX, interestingly enough, today is down. So the VIX today is it's below 30. It's 27.15. It's down almost 0.75% today, which is interesting because the Dow is down 176 points right now. S&P is down 2.76. It's a mere 0.08%. And of course, the NASDAQ composite up again 0.5% this time. So we're seeing natural gas tick up, heating oils ticking up a little bit after having a bit of a wishy-washy day. We're looking at WTI traded on the NYMEX above $40 again. So again, some positives there. And part of the reflection of what we're seeing in the energy space is hope that energy is going to make a turn, and some of that hope is predicated on seeing Warren Buffett take a large stake in Dominion. What Berkshire Hathaway has done with that investment is now controls about 18% of the natural gas in this country, which was it's a tremendous bet. So it's rare that folks, investors, bet against what Warren Buffett is doing, and since he hasn't made a sizable trade investment in some time, and that he's made it in the energy patch, is very interesting to a lot of people. It's creating a little risk on appetite in some of the energy sectors, some pipelines, and some natural gas production, but it doesn't mean that that energy is out of the woods and we're going into a robust bull market for energy. Not by a stretch. It just means that that's a prudent investment on Mr. Buffett's part, which I would love to know the terms of that deal. So let's go take a look. I'm going to see if you all have any questions on any stocks you want to take a look at. And I want to take a look at where we are with the major indices, where we are with the banks and where we are with oil, just to take a look at the sectors that have been moving the market. So I don't see any questions right now, unless we don't have, unless the moderator is not with us, and we don't have any of those. So I'm just going to keep an eye on those, and I'll come back to those after we take a quick look at some charts, because it's interesting. We need to stay on top of what the major benchmarks look like, because if we don't get stimulus for a while, markets could be sorely tested. We're coming into the summer. I don't expect volatility to do anything but remain elevated. I think it's going to increase later in the summer into the early fall. I believe we're going to see substantial increases in volatility, but it wouldn't surprise me to see some of the remaining weeks of the summer things to slow down. We've already seen a precipitous drop in volume. Today, volume on European exchanges was 50% lower than it's been over its last 4-week average. So those numbers are stunning. That's stunningly low volume. Typical of the summer, but not quite that low. 40 to 50% below the 4-week average is that's staggeringly low. Volume here has been lower than its 4-week averages for the majors, but not by a whole lot. That may change now that we are past the midpoint of what people consider the summer in terms of market interest, because as we head towards August, things usually slow down precipitously in August, because a lot of folks are taking August off, whether European investors and US investors. It's really the last month before kids go back to school, before things heat up, before we're making election bets, if you will, and things get a little more intense coming out of the summer. So I expect August to perhaps be slow. We may be starting that process now, which wouldn't be bad if markets consolidate here. That could be healthy, and we will take a look at that graphically. So got a couple of quick questions, and then let's go to some charts, and hopefully you guys, please feel free to pose any questions you have. We'll take a look at some stocks. Sufi is asking about Google. Do we think Google will have a down day, and how much of a pullback is expected? We're going to take a look at that graphically. That's a great question. Peter asks, Shah, weren't you getting the questions last week as well? No, I'm sorry. Peter, I apologize. And I sent an email prior to starting the live stream today to the moderators who rotate in and out of moderating the questions here, that I'd like the questions to remain up until I address them, because I really want to address all of them if I can. And so thank you for bringing that up, Peter. Yes. So I didn't see those questions. They were taken down off the board, and I never got a chance to answer them. So again, my apologies. If you all would want to put any of those questions back up, I'll be more than happy to address them. So let's take a quick look at the charts. I want to start to look at the majors, and we can certainly come back and take a look at some questions. Then go back and look at some charts. So really, it's about today. I want it to be about what you all. My commentary today was really about where we are, and that is we've been going a little bit sideways with an upward bias. We seem to have broken out of that somewhat. We'll take a look at the charts and see if that is indeed the case. That's the tendency to think that way, because that's how it feels. We'll see graphically if that's actually what happened. Forget the NASDAQ. We know what's happened with the NASDAQ. We know the NASDAQ has long since broken out and is on its own ride. But as far as the other benchmarks, we know up week, down week, up week, down week, up week. And what does that mean? But net, we are trending higher. So it's important to see how we look and where we might go, because if things stall out, is today a stall out? Not really. We can't go up every day. I wouldn't consider this a stall. The day's not over. I don't see a reason for there to be a tremendous amount of profit taking on a Tuesday on the heels of what happened yesterday. Again, the banks may be a problem, and if U.S. regulators come out and mandate that banks reserve more and reserve more capital, that is, then we've got another message from regulators that they're worried about banks, and the investors are going to start to wonder what are regulators seeing that we may not be seeing. That is or could be a turning point in this rally. I doubt the regulators will come out with something like that because that sends a very negative message. And the last thing that they want to do is upend the market, let it just continue doing what it's going to do naturally, even though, in my opinion, we don't have free markets. Nonetheless, in these trying times, markets should be left to their own devices because price discovery and transparency is ultimately what is important right now. The last thing we need is markets being manipulated higher to find out at some point that the king has no clothes and we come crashing down. So right now, hardly a prospect because we have mega support from the central bank, and the rest of the markets around the world have mega support from central banks. We're looking at adding about 16, we collectively, the global economy, looking collectively at adding more than $16 trillion in debt this year. That's a staggering amount of debt. We'll be above $200 trillion in global debt by the end of 2020, possibly a lot more, depending on what happens and what additional stimulus is needed and printed. All right, a couple quick questions. I keep getting a little bit off track, but let me just write these down so we can go look at some of your stuff graphically. Peter's asking about RADA. And you say they got a large defense contract still heading down. We'll take a look at one contract, Peter. I don't. It doesn't matter how large you spread over so much time. Oftentimes, it doesn't impact the stock positively as we might expect. But we'll take a look at that. Tommy, WFC, will it go much lower? Tommy, I like I like Wells Fargo. We're going to take a look at it. Can it go lower? Yes, it can go lower. If they cut their dividend, I think the stock can go lower. It's a buy lower. I'm looking to accumulate WFC. I don't mind it going lower because I would not. When I'm looking at a stock like WFC on its lows, trying to pick it up on its lows, I know it can go lower. I'm not, it's a contrarian play in a lot of respects because I don't think the financials are secure. But the way the market's been acting, some positives could turn the financials around and they could take off, in which case I want to be in a stock like Wells Fargo. However, I know, because I don't believe the financials have seen the worst of it. I don't believe that the earnings are going to be that great. I think their trading profits are going to be great for the banks that do have trading operations. But I think the financials are going to get aren't done going down. So for me, Wells Fargo, for example, or any stock that I like that I am just trying to average into, I'll maybe take a 20% position in that. 20% of the capital I want to allocate to that stock and buy more lower. So I don't mind it going lower. I don't go all in at a particular level, especially with a stock that's scraping along near its lows. I want to start buying there. If it goes higher, then I'll pay up for it. So we'll take a look at that graphically, but it's a great question, Tommy. How will earnings affect WFC? We'll talk about earnings too. Peter, TBBK Financial Time to get out before earnings. You're up 30%. You know what we say about being up. Don't leave your profits on the table. Let's take a look at TBBK for Peter. And Peter, WBA wasn't followed, CVS or Rite Aid. Okay, we'll take a look at those. Time to get in. That's a good one, Peter. We'll take a look. I don't know. They've been hard to gauge, but let's take a look graphically. All right, everyone, it's time to hit the charts. So we're going to go to bar charts, our usual landing spot. And first up is the NASDAQ. I already have it up for you. And what do we have here? Well, I haven't even drawn a support line for this uptrending channel. I just have you observe how crazy that is. And it's it looks like one of those stay-at-home stocks. It looks like Zoom. It has zoomed and will probably continue to zoom for all the right reasons, because this index, this benchmark has the players in it, the stocks that people want to own, not just institutions, not just smart investors, but retail investors, investors who are speculating that, okay, well, I want to make money in the market. So what am I going to trade? Well, I'm going to trade the companies that have done well, the companies that have growing earnings, the companies that whose stock is going higher, companies who everyone else thinks are going to continue to do well. So it's a momentum play. Very easy. We got the FANG stocks, we've got Microsoft, and we've got Zoom and a host of other tech company stocks, the work from home, healthcare technology companies, many of them prime and focused in the NASDAQ composite, and hence the stellar growth there. So it's an animal unto itself. And if you're not trading the NASDAQ composite, if you're not trading the QQQs, if you're not trading an ETF that tracks the major tech, mega cap tech companies, you're making a mistake, because that's where the momentum is. All right, let's take a look at the Dow. And here we have a bit of a different story. We've got this sideways channel, which is just really indicative of this action around here lately, and we're trying to break up from there. So have we broken up? No, we've gotten up there. And that there, by the way, corresponds with the 200-day moving average. So here we are. Here's the red line. Here is our 200-day moving average. And for the Dow, we are just touching it today. So we're right now, the 200-day, we can say is probably around 26,281. So we could be a shade lower, but we'll call it around 26. I'm trying to get a little more accurate for you. Yeah, let's call it 26,280. Okay, that's close enough. Dow's down to 26,083 right now. So we are below the 200-day moving average. We saw what happened before. We gapped up above the 200-day and we gapped right back down. So there looks to be perhaps some gap filling to do. Certainly got filled on the way down, and could it get filled again on the way up? Yes, very easy, in which case we'd be above the 200-day. That's what Dow watchers want to see. We would be above this brief sideways channel here where we've got some consolidation, which is healthy, by the way, and we'd be moving back up within the channel at some point, but at least we'd be on the right side of this consolidation, and on the right side of the 200-day, the right side of the 20-day. Right now, we're not there. This is perhaps a little bit cause for concern here. Could we drift back down and stay in here? Yes, we easily could. So Dow is getting hit the hardest today, down 0.77%, and may at some point just reside within a sideways channel for a little while. Why? Because the volume is down. Why? Because it's summer. Why? Because most of the news is out. And what investors are going to concentrate on now are, okay, lockdowns with the COVID on problem. Where are we going to go? Are we going to slow things down? Is the economy going to slow down? Are we going to see more unemployment as businesses have to shutter? So that's what I think the Dow is reflecting there in terms of the industrials. S&P is somewhat similar in terms of its taken a bit of a breather, but it's well above its 200-day. It's above its 20-day. So it's much better shape than the Dow. Don't forget, the Dow reflects more of industrial companies, and the S&P it's more diversified than the Dow for sure. But it doesn't mean that they don't follow one another in a lot of respects. So just got a couple lines to draw, and we'll take a look at this. We can continue to see we still got a pretty decent channel that we are now back up above. And I'm talking about this here. We're above this channel line here, this support line of this uptrending channel. We had broken down here, came right down below the 200-day. We're heading close to the 50-day. We saw a nice bounce. We've had an exceptional bounce back, and we're back up, filling that gap. The gap really is from here to here, so we're pretty close to filling that gap. Question is, what now? Will the market start to see some exhaustion? Will investors take a breather? And those are the questions that remain. Last but not least, I want to take a look at the Russell through the eyes of the IWM symbol, the Russell 2000 share, 2000 ETF. And we see here clearly below its 200, above its 20, above its 50, but certainly in a very nice uptrending channel. The Russell has more room to move, and that's a positive if it continues higher. The Russell's probably going to become a bit of a bellwether, because if the Russell starts to break down, then it means that domestically things aren't looking as good, because the NASDAQ composite, international to be sure, tech to be doubly sure, S&P international to be sure, and industrials are what they are. The Russell is more indicative of what's happening locally with smaller businesses in the US, how they're being impacted by COVID on and being locked down, shut down, losing employees, laying off workers. So we're going to keep a tight eye on the Russell. But so far, so good for the Russell, hanging in there. All right, let's take a look at the financials real quick. We'll start with Wells Fargo. Okay, the financials in the U.S., similar to what happened this morning in European trading, are all getting hit. We'll go through all of the majors real quickly. Now, we know that Wells Fargo is the laggard in the group by far, never had the kind of ascent and breakout from its hit that the other big banks had. However, I look at that as, from the contrarian point of view, as again, give myself a 3 to 5 year horizon. This is a bank that's obviously too big to fail. It's obviously had management problems. It's obviously weighed down by those management problems, regulatory issues, and now the fear that it's going to have to cut its dividend. So the banks are all constructing their capital profiles and capital plans, and at which they have to submit to the Federal Reserve, and we'll start to hear what they are very shortly. And we'll also get a pretty clear picture coming up very soon as to banks' earnings. More important than the earnings, and the earnings for the banks are going to be very important, more important will be any guidance. If the banks provide, and I'm not talking about all of them or one, if a few of the big money center banks provide positive guidance in their earnings announcements, in their earnings discussions with analysts, then that's a super positive. I'm not counting on it, but that would be a real market mover. However, if we get negatives, then this market, the rally, may be sorely tested. Wells Fargo looks pretty ugly in here. So we're down here at 2188, that range. It's really below 22, and we're at 2481. So we got a ways to go before we get down to test the 52-week lows way down here. But that's not that long of a trip for a bank that's been under a lot of duress. Again, I'm not worried about it. It's a long-term hold. If it comes down lower, I buy more. And this is what I would recommend. This is what I'm recommending to subscribers. This is what I'm recommending to anybody who wants to pick up some Wells Fargo. You're just going to have to stick with it. It's not a bounce back stock. However, at some point it could bounce. What really is going to happen for Wells Fargo to change is it's going to have a radical management change. I mean, just really somebody really special has to come in. And I've been wondering who it might be, going over my lists of executives that I think would do a great job. I'm not sure. I don't have anybody front and center that I think would work, but there is somebody out there that I think investors would look to and say, aha, he is the person to lead the bank higher, and that the stock could pop very nicely on the right management changes at Wells Fargo. That being said, yes, if you haven't bought it, you want to wait to see how far it comes down. I think you've got time. I think we can come down, and as what's going to happen is the earnings. The earnings are going to make something happen. Either the Wells Fargo is going to hit its lows, maybe make new lows, or it's going to bounce. And it might come down to its lows and bounce off of its 52-week lows at 22 or slightly below. So if you want to wait. If you own it, again, from my perspective, it's a long-term hold. I'm not overly concerned. If I bought it as a trade and I expect it to make, 20, 30, 40% in a few months, no, I wouldn't have picked Wells Fargo. So that's my opinion of Wells Fargo. The earnings are going to be critical to Wells Fargo. Its capital plan with the Fed is going to be critical to Wells Fargo. It would not surprise me to see Wells Fargo test its 52-week lows. So let's hit all the banks a little bit real quickly in order to see how they look. Because Wells Fargo isn't the only one that's under duress today. Bank of America. Now, long term, by the way, Bank of America, great stock, great bank, and there's no reason not to own Bank of America. It's terrific also. Much better managed, of course, than Wells Fargo. Again, our play on Wells Fargo is bottom fishing. It's trying to catch the stock that has the most room to bounce if and when it starts. However, Bank of America is a great stock. You can see where we left this last time we spoke about Bank of America. We're coming down, right down to that uptrending channel, and we're going to go just extend this, and we'll see where we end up. But what we're seeing here is we're kind of coming right down towards it. Are we going to touch it? Well, we don't know. If we stay above it, then that bodes well for Bank of America. We could see some consolidation in here, but this is a pretty precipitous fall. And we are below the 50-day, we're below the 20-day, and Bank of America just doesn't look good technically right now. So this is a problem for the market. This is what we're seeing today in terms of the Dow, now the S&P. It wouldn't surprise me that if we fall further, if the banks continue to fall today. So that's Bank of America. Citi down. The banks are down similarly, 2.5% today. And again, Citi holding up very well. It's better than Bank of America. It's trading above its 50-day. It's trading below its 20 and well below its 200. So again, similar picture here. Let's just go back to Bank of America real quick. I want to just check something on Bank of America. So technically, Bank of America is just broken down. And I think that's going to create a lot of pressure on the financials, simply looking at Bank of America. Let's go to the big boy, JP Morgan. and down again 2.5%. Um, JP Morgan doesn't look as rosy as one would expect, being the biggest bank in the United States in terms of assets and capitalization. So, well below its 200-day, we're trading around 114.59, and at a price right now $92.58. It is well below its 20, well below its 50, which resides at 96.01. So the 50-day average 96.01, the stock's trading at 92.58. It's got a ways to go and doesn't look great technically. So the banks, the financials are worrisome, and that's what I think the market is leaning on today. So um, not not good news, because we really want to see the financials. If we saw the financials lead, folks, then wow, the market's going a lot higher. But the financials aren't in a position to lead. They aren't even close. In fact, they look like they're breaking down. So that should give us pause in terms of our optimism that the market's momentum can continue robustly. It's going to be challenged in here, especially if the financials continue to break down. Market momentum is going to be definitely challenged. Okay, here's the Bank Corp, TBBK, that Peter was asking about. Peter, you're up 30% on this. It's still in an uptrend. This bank is still in an uptrend. 30%. If you bought it, let's just say you bought it lower on the when it came back down, not that you've held it for a long time. You're up 30%. If you're up 30% on a trade, I would be nervous about giving up my beautiful gains. I hate to give up gains. 30% gain is a big, you can always get back in. So I'm trying to just see where we are right around here. This is a pretty ugly downtrend here. And we've got a little bit of this triangle here, which generally when you have a formation like that, a stock can go above or below that triangle, and it's a descending triangle. Generally, if we see a descending triangle break through the bottom of that support, it doesn't bode well. Even if you try and create some line of support there through a lot of that volatility, we're below that. You got a lot of room down here, Peter. Me personally, I have a stock that I've got 30% in. And as I've said, I don't like the financials, and we're coming up to earnings. I'm not looking for positives in the earnings. I'm looking for negatives. It's a question of will they beat consensus estimates. That may not work this time. If they beat consensus estimates, because consensus estimates have been brought down, investors still may say, so what? Generally speaking, when you get positive beats versus consensus estimates, then we tend to see a pop in the stocks, and we tend to see a pop in markets. This time for the banks, they're going to have to beat nicely, and they're going to have to provide better guidance. And if they start to, if we see increases in what they're provisioning for loan losses, then the financials are going to test their 52-week lows. So I'd be apprehensive about leaving my nice profit on the table there going into earnings. And we've got, let's see, Sufi was asking about Google. Absolutely stellar rise, and profitability wise, when you see a stock move like this, here, we're looking here at the highs, and we're within earshot of that. So let's go to the high water mark here, and I believe we're coming right here. So on this bar, high is 1532. We're at 1507. I'm hard pressed to think if the market, if the NASDAQ continues, if the rest of the market, if the other benchmarks don't get hammered, then I got to believe that Google Alphabet is going to stretch to try, investors are going to try and see if they can take it to new highs and bring in more capital from the sidelines. So certainly looks pretty healthy. Action like this is a little scary, but we know these stocks are prone to that. We know they're prone to all kinds of sell downs for all kinds of reasons. However, if you look at the long term picture here, it's just extremely healthy. Would I be worried about Google? No, I wouldn't be worried about Google. But then again, my perspective on the market is we've got some momentum, and if it continues, and we got a lot of support right there for Google at its right, which would come down to its 50-day, which is 1400. Meantime, you got this big breakout here, um, and that's a positive. So I would be hanging in there. If you're worried, if you were speculative and you bought down here and you got a monumental profit, then yeah, maybe take some off the table. But it looks to me like Google's got farther to go. Again, unless we see the financials get hit, which be an indicator that maybe all is not well with the economy and or things are starting to reverse. So hopefully that helps you, Sufi, with Google. But just pretty good action in the stock price there. Um, we're talking about let's look at. I think Peter was asking about this stock, Rada Electric Industries, and I believe you said that they got a government contract. I don't know the company. I would say that's one heck of a rise higher. Yeah, I wouldn't be worried about it. If you have such a huge profit in it, and, six bucks, maybe put to me like $6. I'd be willing to stay with this till $6, and then it'd be like, okay, I've made my profit, time to get out. But that's a heck of a run and looks awfully strong. So I wouldn't worry about it. I'd simply continue to try and ride that momentum until it breaks down. For me, $6 is like, okay, I've had my fun, made my money, time to exit and see what happens next. Okay, we've got WBA up next. Okay. Now, the pharmacy companies, Walgreens Boots Alliance, the merger of the two has created so much debt on the balance sheet, and they haven't been able to gain economies of scale. Partly because we're talking about um, companies on either side of the Atlantic. So there hasn't been the types of synergies that investors expect when you have an alliance like this, when you have a merger of two giants. Just hasn't been there. We haven't seen economies of scale come into play. We haven't seen savings come into play. Just hasn't happened. So this stock continues to baffle a lot of investors. I think at some point they're going to get their act together, and they're going to. It may be a buy, but right now it's not. And are we getting there? We're above the 50. We're above the 20. It's not a bad place to maybe take a stance. If you like it long term, then you've got some a little bit of support down here around the 39.45 level. Stocks at 42.29 now. And if you're thinking about buying this for the longer term and hopefully they get their act together, then yeah, you might want to look at it here and maybe add a little bit more later at 39.45. Hope it doesn't break down there, or add a little more down to the lows and then see what happens. But the stock has just been such a laggard in every respect. And even before, if we just go back here, we're going backwards here. You just look at this. This is just ridiculous. We're going back to 18, and look at that's just. Let's take a look at this history. How brief is this? Okay, so we have pretty volatile stock, underperforming, come down, 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 had a bit of a spike. Okay, so what? We got a nice merger, then bam, just good night. Just awful. Why would you want to own this? You're owning it down here is a bottom fishing play. It's like trying to catch a falling knife. Can this stock go lower? Sure, it can go lower. Will it go lower? I don't know. It's just not something that I would put down as a potential investment right now. That if I accumulate some Walgreens, that I think I have a chance of turning that into a long-term investment. That it has a long way to go up. I think there are certainly other companies in the same industry that have better prospects. I know it's got a pretty decent yield. I'm going to go take a look at it. Yeah, let's take a look at the yield. There's 4.31%. But let's take a look at the debt. Again, I've looked at this stock and wondered why. Well, what are they doing? This stock at some point should be. I want to bottom fish, own it, and I think it's got prospects. But I keep looking at the debt. I keep looking at how investors are looking at the stock, and I keep saying no, not yet. Not a time to take. Again, when you're looking at something like this, the question should be, where else can you put your capital? Right? It's not about is this a good company? It's about, is this a good stock relative to where else you can deploy your capital? And oftentimes investors don't think about that. They just think, how is this going to do? I never think that way. I always think about relative to my allocation of capital to this, what's a better play? And this has been an easy answer for me. This hasn't been a good, worthwhile place to park any of my capital. So I'm going to Yahoo, just going to have a quick look at the statistics and see what we're looking at here. We got a capitalization market cap of 36, I'll call it $37 billion. The margins are slim, 2.52, which is typical of these pharmacy companies. There's always so much potential with these companies in terms of what they could be doing. And that's something that baffles a lot of investors. But we're looking at 42, we'll call it 42, going to round up $42 billion in debt. That's a monumental amount of debt. The payout ratio on the dividend is 46%, so it looks to be secure. The operating cash flow is certainly good at 6.8 plus billion. Levered free cash flow, 4 billion is good. So it's good enough to sustain the dividend for now. So yeah, at some point, I hope they get their act together, because I would like to own this company, because it looks like it's one of those ones that you want to own because it's on its heels, and it can have a great rise. Look at CVS Corporation, and you say, well, okay, much better in terms of the stock, much better in terms of, we go back a little here. Look at this. This stock has been tumultuous, but it's certainly on uptrend. It's had a lot more volatility, up and down, up and down, up and down. Again, so these companies, the reason these pharmacy companies are going up and down is because investors expect them to do more, and they haven't done it. You expect them to open up offices within there, lots of things that they could and should be doing, and I don't know why. Maybe there are regulatory reasons that I don't understand, though I've looked into them. They seem to be clear to do a lot of things I think they should be doing, but they're not moving aggressively enough. So CVS, it's another stock that you think, this is a great business. It's not going away. You want to be in that business. You want to own a company in that business. 3.11% dividend yield here. but then the stock looks like it's trying to consolidate in here, maybe break out. But where's it going to go to 75? Its 52-week high is 77. So again, you're going to put your capital in here. Frankly, I'd rather speculate on um, Walgreens boots. With an understanding. At least the dividend seems to be safe, and I'm getting a better yield to sit on that. But like I said, I'm not going to allocate capital. I just don't think it's going to move relative to some of what the tech stocks are doing or some of the other healthcare tech companies are going to do. And that's how I look at these. And I think you asked about Rite Aid. The symbol is RAD. And no, of the three, Rite Aid has performed the best lately. It really but if you look at the history again, you look at the history, it's like so you're bottom fishing. What an ugly mess, right? We're going back to 17. Look at this. We're talking about just ridiculous. We'll go back to 2017. We're at $176, down, 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 trading below the 200-day, consistently below it. Pierces it here, double top, gets right back down below. We go from 170 down to here. Come on, folks. Seriously. This is just now a speculative stock. It's like, really, why would you want to play a stock like that other than, a bottom fishing round of, it's got to go higher. It's got to go higher. It doesn't have to go higher. Okay. Again, it doesn't have to go higher. Yes, it looks cheap. If you're looking at a $18 stock versus $170 that it once was, can it get back up there? Sure, it can get back up there. But then again, when? How long? And what else are you going to do with your capital? So I'm not keen on any of these. I would have to say, honestly, I know this sounds silly based on everything I just said. I'd throw in with Walgreens boots for its dividend before I throw in with any of the others. I know of the three, Rite Aid looks like it's ready to try and make a move. But if you take a look at this volatility, it's above. It's certainly the best looking in terms of its chart, but where's it going to go? I wonder, but that's at 1837 now. And what's the 52-week high? 2388. So it can go up there. Okay. Is it going to break above there? Maybe, but I'm just not inclined to chase that. So that's a good look at the pharmacy companies. And again, would love to invest in that space. It just hasn't been exciting enough for me. I just wish that they would get their act together and do some of the things that they're capable of doing. Why they haven't, I have no idea. It's frustrated me because I've looked at them for a couple of years and not seen anything exciting happen. I haven't seen management make any of the moves that I think they should have made. Baffles me to the nth degree. All right, a couple more questions. Yeah, so Peter, as far as Walgreens boots, yeah, if you want to take a shot at it, of the three, that's the one I would take a shot at because of the dividend. And again, be patient if you're going to take that route. Peter also asks, I know any ETFs are into REITs of tech property. Yes, I'll give you some on Thursday. Same for warehousing using robotics as labor. That's a good question. No, I'm going to look into that. Warehousing using robotics as labor. That's good. See if I can find out something on that. That's pretty cool. But we've talked about robotics and some companies that I like there. We'll talk about those again in the future. But yeah, certainly some good companies in that space. Last but not least, Hal's asking about Halliburton. So let's maybe have a look at the chart on Halliburton. These plays KK, these plays, Halliburton are, to me, speculative. They are, I'm not, I understand Warren Buffett's play on Dominion. He's a long-term investor. He had 90 years old. He's still a long-term investor. He's looking at that 5% yield. He's looking at that, is that he's going to be in charge of whether that's going to be maintained or not. And if he cuts it, it's not because he doesn't need the money. Who doesn't want to get nice? It's because he'd rather put the capital towards growing the business or perhaps additional acquisitions or servicing the debt, because that's the long-term perspective. But if you look at Dominion, stock hasn't performed well. Halliburton hasn't performed well. Dominion's obviously had a pop because of the Buffett thing, but even then, it's gone down. So I'm not interested in it. It's too speculative right now. Halliburton is the same way for me. It just hasn't proven anything. If you want to go bottom fishing, you can, yes, take a shot. That being said, the 52-week low is $4.25. Okay, the 52-week high is $25. Are we capable of heading back down to $4? I don't think so. I think the worst is over in energy patch. The worst is over for oil services companies, but doesn't mean we can't drift a lot lower. So if you're going to head into Halliburton, KK, I would just be mindful of the downside. It's not something I'd be comfortable jumping in and forgetting about, even as long-term investor, because it could take a while. So I'd be cautious on that. All right, everybody, thank you very much for your time today. As we part, I'll leave you with the Dow looks like it's close to its lows of the day, down 224 is 0.85%. S&P trading down. It was holding up. It's down 0.32%. NASDAQ coming off of its highs. Let's see what the VIX is doing. NASDAQ is only up 0.14%. It was up more than 0.5% earlier, and trying to pull the other benchmarks higher. Didn't really have any luck doing that. It did help the S&P. And let's see, dollar continues. It's a little bit of back on a bit of a run higher after having a choppy month to the downside. Oil holding up, and the VIX again down slightly on the day. Surprising, down 27.89. At some point, buying calls on the VIX isn't going to be a bad play. I think if you're going to do that, I think volatility is going to pick up. It may pick up towards the end of August, or may pick up anytime between now and then. But it's going to pick up. I like playing the VIX from the upside. Another way to play the VIX is to sell puts on the VIX. I like selling the 30 puts. I like selling the 25 puts if you go out a month. Because I don't think the VIX is going to consistently, I don't think the VIX is going to get below 25. It's possible if we go into a really sideways period, I think the VIX will mellow out, maybe see 25, possibly below, but it's going to percolate back up. And certainly as the year progresses, I think the VIX is going to be all over the map, including spiking again north of, I think we're going to see the VIX in the 40 plus column at some point heading into the election. And if we get a kind of reaction to whatever's going on in the political arena, the VIX could certainly spike north of 50 again. So not unlikely. Highly probable. So keep that in mind. There's lots of opportunities to play the VIX. We'll talk about some of those next week. And just as an FYI, we've sold puts on the VIX at 30, and they expire next month. And I think we're going to do well with those. We'll probably keep that premium. So that's it for today, everybody. The last look, nothing new. We pretty much covered most of the ground for today. Have a great day. I'll catch you all on Thursday. Cheers. Be safe out there.